My guest today is Professor Anusha Chari, who's Professor of Economics and Finance at the University of North Carolina, Chapel Hill. Her research is in the fields of macroeconomics, international finance, and empirical corporate finance. Welcome, Anusha.
Thank you. It's good to see you.
Yeah, thanks for doing this. So I want to start with perhaps one of your older papers, Taper Tantrums, Quantitative Easing, Its Aftermath, and Emerging Market Capital Flows. You say this paper examines the spillover effects of US unconventional monetary policy on emerging market capital flows and asset prices. You say that a term structure model estimates show that US monetary policy shocks identified with high frequency Treasury futures data represent revisions to the expected short-term yields and term premia, especially during this unconventional monetary policy period. So the policy shocks exhibit sizable effects on US holdings of emerging market assets. So it is quite intuitive, but to set the context, unconventional monetary policy, that is what you mean by quantitative easing?
Yes, indeed. So the paper was written in sort of after the global financial crisis. And what we saw was that during the global financial crisis, initially there were massive outflows of capital from emerging markets back into developed markets, particularly the US. And that was sort of more to make good on margin calls and that kind of thing that were happening at during the immediacy of the crisis as it was occurring. But very quickly, what we saw was that by about February 2009, capital flows to emerging markets had resumed with great force, in fact. And to the extent that at a certain point following sort of in 2009, 2010, during that period, the Brazilian president, Dilma Rousseff, she referred to it as a monetary tsunami, which was, capital was flowing in, gushing into emerging markets, was fueling inflation, and was posing a lot of constraints on emerging market central bankers as to what to do with these smaller financial systems that were being inundated with capital. Now, from an academic point of view, it becomes very difficult during that period to look at the impact of US monetary policy on these emerging market flows and returns, primarily because the interest rates had hit the zero lower bound. So you can't really put an interest rate variable, a zero on, into your regression specification, for example. So we focused on what you're referring to as unconventional monetary policy, which was the large scale asset purchases that the Fed was doing during that time, and really set the stage, I think, for the kinds of unconventional policies the Fed could undertake during the COVID crisis, for example.
So is a sort of a simplistic way of understanding this, Anusha, is it there is sort of free money in the developed markets, and perhaps because of the 2008 shock and the COVID shock, there is higher expectations of returns, higher returns perhaps in emerging markets. And so money sort of rushing from where it's available to where it could find some returns.
Yeah, these were definitely what we call search for yield flows. So if your assets are going to return very low yields in the US, and when the Treasury, the rates have sort of hit the zero lower bound, we had two things going on, right? So rates in the US are very low. The Treasury had also purchased a lot of long duration assets. And so what that meant was this risk premium on the long end fell, right? So the duration risk was removed from the market. And combined with that sort of falling risk premia, low interest rates or zero at the zero lower bound, both combined to push these flows into emerging markets. And that's one of the reasons we used a term structure model, because you can distinguish between the term premia versus the short end yields.
Yeah, so this integrated world economy, one country's monetary policy affects everybody, right? So as you say, if these flows are really big, it creates a big dislocation, right, in this emerging markets.
Absolutely, absolutely. Because you see the US and other developed markets, say Japan or Europe, even Australia, for example, they have very well developed, deep financial markets, right? So money sloshes in and out of the US, but we don't really talk about it that much, you know? Whereas in smaller financial systems that don't necessarily have that depth or the breadth, you know, foreign investor portfolio flows have massive impacts, you know, either when they go in or when they go out. So right now, you know, in the context of the Russian crisis, a lot of money is actually flowing out of emerging markets, also in anticipation of rates normalization in the US.
Yes, it's truly a tsunami. And so in some sense, when sometimes, the people say fools rush in, when everybody's rushing in, the expectations of return cannot be materialized, I would imagine. I mean, if you're going in and buying assets because there's free money available, what happens exposed? What are the returns that we actually see in these markets after this shock?
So you see in our study, what you find is that there are significant asset price impacts, right? And so the way that we can design our study is to see what happens to returns when the money comes in. And there are these sizable impacts on these returns when money comes in. And conversely, there are sizable impacts on returns when the money flows out, right? So you said fools rush in, but you also don't, if money is flowing out, you don't necessarily want to be the last ones left, you know, holding the baby. So there tends to be these sort of feedback effects or loops, right? If prices start falling in emerging markets, investors start heading for the doors, and then when other investors see that the prices are falling, you know, they start leaving as well. So you have these sort of reinforcing feedback loops which feed into prices via these flows in out of emerging markets. You could see the opposite thing happening when money is flowing in.
Yeah, so you have a recent paper that's also sort of related, global fund flows and emerging market tail risk. So global risk and risk aversion shocks have distinct distributional impacts on emerging market capital flows and returns, you say. In particular, there are salient consequences of global risk on and risk off shocks for tail risk in emerging markets. And you talk about here open-end mutual fund trading provides a key mechanism linking shocks facing global investors to extreme capital flow and return realizations. So, so what's the mechanism there? I mean, we can, sort of at a very high level understand money going in and money coming out based on some expectations. But then, yeah, this open-end mutual fund, they have constraints, they have heuristics that they have to keep. Perhaps there is some sort of, I think you talk about here, some sort of linking to a benchmark. So all those things sort of create a big issue for these markets, I would think, right?
Yeah, so I think the overarching question that we try to address in this paper is, are index funds harmful for global financial stability, right? So I can walk you through a very simple way to think about this, right? So let's think about an open-end mutual fund, and think about, you have assets and liabilities. Open-end mutual funds are a very low-cost vehicle for many of us to get exposure to emerging markets and international exposure in general, right? So we have our investments in our retirement accounts and so on. And now if you look at, Vanguard or any of these providers will have some sort of offering of international exposure. And in fact, Vanguard says that about 40% of their plans have some sort of emerging market exposure. And this is very different from, say, 20 years ago when, emerging market investing was considered very risky, and you would get all of these warnings, be aware that you're, and, including an asset class that is exposed to risk and so on. But going back to this balance sheet, let's think about the assets and liabilities, right, for an mutual fund that is investing in emerging markets. So on the liability side, we have our investor funds, right? So investors have subscriptions, and that is the investor capital that is invested with the fund. And this is highly liquid, right? So you can have daily subscriptions and redemptions in response to something, any sort of shock that might impact global investor risk appetite. And this risk appetite is what, the financial press, policymakers, and also loosely refer to risk on, risk off. So if you have a risk on shock, you're more, global investor risk appetite is willing to take on risk. And when it's risk off, they want the risk off their portfolios. So on the asset side, we have, if we think about these funds, so on the liabilities, it's these investor funds that have been invested with the mutual fund. And on the liability side, they have two things that we can broadly think of. One is their investments in these emerging market assets, and the other is some sort of a cash buffer. Right now, the cash buffer is very necessary because if there is any sort of shock, you want to be able to make good on.
You mean on the asset side, right?
On the asset side, yeah. Yes. So you want to be able to make good on those subscriptions, those redemptions as quickly as possible. On the asset side, when we think about the emerging market assets, they tend to be on the equity side, they are somewhat illiquid, but on the bond side, they're very illiquid, right? So you're investing in these markets where liquidity may be a concern, right? So, you may not be able to redeem your investment, as soon as you want to, for example. So these cash buffers become sort of important. But the cash buffers also, there's a trade-off, right? On the one hand, you can make good on these liquidity demands that could arise, but on the other hand, they're a drag on performance, right? So if you have cash earning some low yield, that's not going to be providing you with the returns that you were hoping for by investing in these higher return assets. So this is where the benchmarking comes in, right? So a lot of these mutual fund managers, their performance, their pay for performance depends on some sort of benchmark. And so, popular benchmarks for equity are, say, MSCI World, Morgan Stanley Capital International's World Index, or JP Morgan's MB Index for emerging market bonds. And these can be in US dollars or in local currency. And so what happens is that if the mutual fund managers are benchmarking to these well-known indices, then their portfolio allocations mimic the weights that are in these indices. So a pool of money comes into the mutual fund, and then the managers take it and allocate it according to the weights that are given in these indices, right? And let's say those weights get rebalanced, then the fund managers also rebalance, because in terms of performance, they are going to be judged on doing at least as good as the benchmark, if not better. And so here, the active versus passive funds become important, because passive funds are just mechanically benchmarking to the index, whereas active funds have a little more discretion. Although some would argue that even though these active funds, they earn sizable fees, they are closet indexers, right? So we have, this heterogeneity in the investment space. You also have ETFs that are investing in emerging markets. So once you have this asset liability position in your mind, let's see what happens when let's say an adverse global shock hits, right? So let's say, the Russia crisis happens. All of a sudden, the VIX index goes crazy, and global investor risk appetite really falls especially in terms of exposure to these risky emerging markets, what are considered risky emerging markets. And so what would happen there is that if there are redemptions, for example, from the mutual fund, then there's sort of going to be a mechanical rebalancing out of the emerging markets, and that's going to be in line with trying to maintain those portfolio weights to remain consistent with the index to which they are benchmarking. And just as I mentioned a little bit earlier, so money flows out of the emerging market because the index mutual funds are pulling out. Returns take a beating in the emerging market. Other investors see this, and then the redemptions can increase, and this feedback loop can sort of happen, which leads to price pressures in emerging market assets.
Yeah, I was thinking, Anusha, is there a need for open-end mutual funds anymore? If they are indexing, if they're benchmarking, presumably they have some alpha coming from some sort of selection process. But it seems like if the world is really just looking for diversification and emerging market exposure, you can get it through ETFs, couldn't you? I mean, what is the need for open-end mutual funds anymore?
As far as the mutual funds are concerned, it's sort of, we make a distinction between passive index funds and active index funds, right? So as you are mentioning, the active index funds or active mutual funds are the places where you would expect to get more of an alpha, right? So as far as the passive funds are concerned, you're just going to do as well as the benchmark index. You're not going to get any further alpha. At least you don't expect to get a further alpha. So as far as the active funds are concerned, the idea is that these managers have some sort of additional information, or they have a way to allocate the portfolio in a way that they can generate that positive alpha and be able to distinguish, right? Distinguish between, say, an Argentina and a Peru versus Mexico and Chile, and be able to take that country heterogeneity into account when they are making their investments. So as far as these active investing styles are concerned, we still need the mutual funds, but as far as the ETFs are concerned, they're sort of very similar, right? So to the closed-end indexing mutual fund space, and just the mechanics is a little bit different when we consider subscriptions and redemptions.
Yeah, this is not in your research, but I want to ask you, what is the have you seen any sort of cross-sectional data in terms of alpha from active mutual funds? Are they actually creating any positive alpha?
So in our data, unfortunately, we don't see that, right? So in fact, this is why I made the closet indexers comment, which is that first of all, one thing that surprised us was that we really thought that investor heterogeneity would play an important role, right? For the passive funds, we thought they would just be allocating according to the weights in the index. And for the active funds, we thought that they are going to have much more of a strategy, and that the portfolio allocations themselves are going to be quite different. But when we actually looked at the portfolio allocations of the two types of funds, we saw that the active funds are actually, allocating pretty much almost identically to the passive funds. There is one important distinction, though, which is that when these global shocks hit, which tells us something about the investor pool. that there might be some heterogeneity in the investor pool that it goes for active investing versus passive investing. Because in the case of our, when we look at our global risk on risk off shocks, you see these massive reactions on the passive fund side, but pretty much almost no reaction on the active fund side, right? So at least in response to this global investor risk appetite that we're capturing, the active funds are able to keep, stay in. So they are not the ones who are, rushing for the gates as soon as something adverse happens. And that tells us that perhaps there is something distinct about the investors who are willing to take these positions with active funds.
Yeah, that makes a lot of sense. In an active fund, you can imagine there's somebody at the wheel.
Mm-hmm.
Whether that person is really good at what he or she is doing is another question, but there's somebody there. In the case of passive funds, you have to essentially take control of yourself because there's nobody at the wheel, and it's just a heuristic that's going to allocate based on whatever you see, right?
Exactly, and that is also like it's the mandate, right? So basically, you are allocating your weights according to this index. That's what the benchmarking is all about. And in the face of significant redemptions, you are going to pull out in line with those weights, right? And this is what it's also interesting is that this what this research showed us is that this is what can mechanically generate cross-market correlations, right? So if a certain pool of money is being pulled out of emerging markets, it's being done in line with the weights that are in the index. So if you're pulling out of Brazil, you're also pulling out of Chile, you're also pulling out of Mexico, and so the return correlations for all these markets would also increase in line with the mutual fund outflows. So the granularity of these data, of actually being able to look at how these allocations are changing, provides some insight into what we used to consider myopic foreign investors who leave at the first sign of trouble. So there seems to be something mechanical going on here in terms of fund benchmarking.
Yeah, I think that's what you talk about in the paper. So if I'm a fund manager and investing in BRIC countries, and let's say there's a shock in India, and there are a lot of redemptions, I'm managing a pool of money. I have to pull money out, not just from India, but all the other countries that I'm investing in. So it sort of links everything together, right? The shock gets transmitted across the whole system very quickly.
Exactly. So it's, you can't just pull money just out of India, because then that will throw the weights out of whack, right? Unless you have a situation like Russia, right? Where Russia just recently got dropped from the MSCI index. And in the past, there have just been a couple of occasions where this has happened. For example, during the Asian financial crisis, when Malaysia put controls on capital outflows, so foreign capital got trapped in Malaysia, that created a very risky situation, and Malaysia dropped out of all buy lists, right? And so, but it was about 18 months to 2 years when they were re-included into the index. But that's exactly what's happening with Russia. Let's say, Russia's weight goes to 0, then all of a sudden, all these funds have no option that are benchmarking to the MSCI World Index have to necessarily make the weight on Russia equal to 0 in their portfolio. And that's the kind of, the massive outflows, as and when the money can come out. It's certainly not going in if the weight is 0.
Yeah, Russia's a sort of a unique situation. There is sort of a differential movement, significant differential movement, right? So presumably I can take money out of Russia, I mean, if I can get it, and put it somewhere else. But when there's a global shock, then you don't have any such luxury, right? You're essentially trying to get out. So that is the risk on, risk off trade. When the risk is off, you're basically pulling out from everywhere simultaneously.
Exactly. Yes, yes, absolutely. But I mean, I also think that, okay, fine, we take Russia out of the index, it's zero, and then, it could be business as usual in emerging markets, right? And you're absolutely right that this is a very unique shock. And, I was talking to some of my colleagues who work on capital flows, and, this is the first time we've talked about sovereign debt defaults, we've talked about fiscal crises in emerging markets. We've talked about contagion during the Asian financial crisis. We've talked about the Argentine crisis, and how all of this impacts the geography of capital flows to emerging markets. We talk about, we just talked about taper tantrums and unconventional monetary policy. QE, the money goes in; taper, the money comes out. COVID, initially money came out, then it went back in. Now there's talk of rates normalization money is coming out. So this is, kind of the more global risk on, risk off shocks that we could talk about, or even country specific shocks, right? But what we were talking about was, it was really up until Russia happened in recent times. I'm sure there are examples, from historical examples, but it's sort of geopolitical implications have taken on a huge role in sort of the international financial system, and the steps that are being taken to shut Russia out or cut it out of the international financial system and monetary order, right? Which is very unique, because if we think about before 1990, or during the communist era, these countries were essentially in autarky, right? The Soviet bloc was in autarky, and so they weren't, connected to the West or to the international financial system. But that's all changed, and Russia, has become exposed to the international financial system, and this shock has meant that it's sort of facing some repercussions.
Yeah, it's interesting policy question. All these autarkies might sort of go back and say, look what happened to us because we connected with the international system. It doesn't appear to be beneficial. But I also wonder, Anusha, there is some sort of a hysteresis in the shocks, because we've been getting a lot of shocks, one after the other. And I wonder if people are sort of getting used to shocks. I can't quite remember, didn't long-term capital fail because of a Russian default scenario?
Yeah, I'm a little hazy on the details. Yeah, there
Yeah.
was I mean, I think the fundamental point is the world has become very interconnected, right? So there's this interesting paper that I once read, which was, when the Fed sneezes, who catches a cold, right? And it's just that notion of something happens, a tree falls somewhere, and it's felt across the globe.
Yeah, so I want to go into another sort of related paper, In Search of Distress Risk in Emerging Markets. You say the paper employs a novel multi-country data set of corporate defaults to develop a model of distress risk specific to emerging markets. The data suggests that global financial variables such as US interest rates and shifts in global liquidity, that risk aversion, have significant predictive power for forecasting corporate distress risk in emerging markets. Yeah, this is a little bit counterintuitive for me. So, I mean, this goes back to this idea that everything is interconnected. And so you are never on an island. If you have a company somewhere, you are really exposed to a lot of interconnected risks. And something happens somewhere else and you could be in distress, right? So that's what the data is showing.
Yes, absolutely. So this was a paper where we sort of, when we started writing it, first of all, when you do research on emerging markets, a big constraint is data, right? So if you don't have good, rich, granular data, you might have lots of hypotheses you want to test, but the data is simply not there, right? And so the more kind of this granular data has become available, we can sort of test, we can go out there and see, well, what are the factors that drive distress risk in emerging markets? And when we sort of did a literature review to see what's the evidence out there, what do we already know, what we saw was that not much had been written, and the little that had been written, it was just taking, U.S. bankruptcy models and applying the same model to the emerging market context, right? And so then what we did was we said, okay, let's start off by doing that. And let's sort of see how that model performs. And you could see that compared to the model performance in the US or a developed market context, there was a lot of unexplained variation, right? So there was a lot, these models weren't doing as well as predicting, because you're trying to forecast and you're trying to predict defaults and you're trying to predict distress, kind of put a number in that expectation of what is distress risk. And these models weren't doing so well. So then we decided, okay, well, what's missing, right? And then we went back to this notion of interconnectedness, that these emerging markets, we know that from the capital flows evidence that these asset returns in emerging markets are very impacted by global flows, and so on. And, if a lot of these companies are listed on emerging stock markets, they are being hit with these global risk on, risk off shocks, for example, right? And so we wanted to sort of quantify that and look at building in global variables to see if that could explain distress risk in emerging markets and improve the forecasting ability of these models. And so once we introduced, and we also, we have a companion paper where we also use some machine learning techniques to, instead of just saying, let's just take the model from the US and apply it to the US, to emerging markets, let's use some machine learning and try to see what are the variables that are the most salient in an emerging market context. And in addition to sort of accounting and market variables that are traditionally used in these bankruptcy forecasting models, what we found is that the global variables, become very salient in the emerging market context.
Yeah, I mean, it's very intuitive. And I was thinking, Anusha, that there are sort of two types of connectedness. One is in the real markets. So if you are supplying, if you are in a sort of a supply chain for world production, that's a real market risk, a real market sort of shock, right? Then there's financial market. So this is money coming in and money going out in large amounts. So these companies are sort of hit with two things simultaneously, right? And that probably has some implications.
Yes, absolutely. And I think that's been brought into sharp relief with the COVID crisis, right? Because before we could talk about, there was this interconnectedness of trade flows and financial flows that people would talk about. But if you think about the way that research is done, you might include some trade variables into your specification, you take the current account into account or something like that. Or the real exchange rate, right? When you're trying to explain how capital is flowing across the globe. But generally, there was this kind of disconnect between the way that trade economists were approaching trade flows and studying global value chains and how these supply chains are organized, how is production organized across borders, and then it was sort of like the finance was layered on top of that, right? And how is capital flowing? And because one point I should make is that I have another older paper which was looking at cross-border mergers and acquisitions in emerging markets. And so there, the idea is that rather than thinking about greenfield investment, right? So foreign direct investment, the foreign company comes in, they have to build everything from the ground up, the plant, machinery, set everything up, employ local labor and set up the operations. But particularly, starting in the late 90s and, all through the 2000s, cross-border mergers and acquisitions have really taken off. And so there it becomes this question of, there's a financial flow, right? There's an acquisition, but that is buying a real plant or a real factory or a real firm in another country, and that sort of connects. Then the question becomes, what is driving these acquisitions? And that's sort of a bridge between the trade flows and the financial flows, because often what we found in our study of these cross-border mergers and acquisitions is that it becomes this make versus buy argument, right? Like, why would you make something in an emerging market if you could just outsource it and buy it as an input into the global value chain? And that really has to do with the boundaries of the firm and being able to protect intellectual property and things like that, and the institutional framework in the emerging market, where you might have concerns that you will not be able to enforce intellectual property rights. For example, that famous Mattel case where the paint came from some supplier outside. And so that is a way, the acquisition is a way to bring that foreign firm into the boundaries of the firm that's located in the US, creating that value chain. But the way it happens is through a financial flow.
Mm. Yeah, I was also thinking about some sort of optionality for this firm. So COVID-19 is a good example. All supply chain participants became very efficient, just-in-time manufacturing, just-in-time delivery. You take all flexibility out of the system. You really, clearly fine-tune it to the extent that it's working beautifully. The problem with taking optionality out of it and flexibility out of it is that when you get a shock, it becomes very brittle. And I think that's what we saw in COVID-19, right?
Absolutely. I just agree with you 100%. Like, there's no inventory, right?
Right.
So it's across industries. If you have no inventory, and and as you said, it works beautifully. It's highly efficient. I used to watch, when I ordered a laptop computer, and then I could track it on FedEx as it left China to go somewhere else in East Asia. And then, 2 days later, it was in Raleigh and I was getting delivery. And you could see the whole supply chain in operation. But, as soon as you have something breaks down, parts are not available. And I think the COVID crisis is really, it's been so heterogeneous in its impact. Some countries have come back online, others are still offline, but if this finely calibrated value chain, as you said, becomes highly disrupted.
Yeah, so I want to go into another paper, spillovers at the extremes, the macro-prudential stance and vulnerability to the global financial cycle. So you say the effects of macro-prudential policy on portfolio flows vary considerably across the global financial cycle. A tighter ex-ante macro-prudential stance amplifies the impact of global risk shocks on bond and equity flows, increasing outflows significantly more during risk-off episodes and increasing inflows significantly more during risk-on episodes. This is a bit counterintuitive for me, Anusha. So what do you mean by macro-prudential policy to start with?
So macro-prudential policy has really come into vogue, especially after the global financial crisis, which, as we know, was in the US was, driven by the housing sector, right? So once you had the global financial crisis, there were a lot of regulations that were put into place as safeguards, particularly for the banking system, right? So loan to value ratios is one example of a macroprudential policy that is targeted towards the housing sector. And the main goal of these macroprudential policies is to prevent the buildup of leverage during good times, which then leads to crashes during bad times, right? So it's to moderate these boom bust cycles that we see in financial systems. Like, everything is going gung ho, it goes too far, something happens, some bad shock happens, it collapses. And to kind of moderate both the good times and so that, not to have too high highs so that the lows aren't as low as they tend to be. So to moderate the financial cycle, essentially by trying to put in place regulations that will moderate leverage buildup, for example. In emerging markets, a lot of countries are not able to borrow in their own currencies. So they end up borrowing in foreign currencies, right? So now your assets might be in Indian rupees, but you've borrowed in US dollars, and any sort of shock that hits that leads to a depreciation of a rupee immediately becomes an adverse balance sheet event for the companies that have borrowed in dollars, because now you have to repay more rupees to make good on that same dollar loan. So macro-pru in a lot of countries that borrow in foreign currencies has been targeted towards foreign currency borrowing by banks, for example. So these are examples of safeguards that have been put into place to sort of make the banking system more sound and less vulnerable to shocks, right? And so you're absolutely right that what we find is counterintuitive, because macroprudential policy, and I'm a huge fan of it for the banking sector, is designed to make the banking sector safer, right? And less subject to shocks and less subject to boom bust cycles. However, capital is fungible. So the moment you don't allow mortgage-backed loans, the financial system can turn to unsecured debt, right? And the moment you don't allow foreign currency borrowing by domestic banks, firms can turn to issuing foreign currency denominated bonds, right? So what we find is that while macroprudential policy makes the banking system safer, there are spillovers to other types of flows, namely portfolio flows. And we focus on the distributional impacts because if you just look at sort of the mean effect or the median effect, you may not capture what's going on. So what we really need is big shocks on either end to kind of, have the data confess as to what's happening. And what we see is that, especially in response to these big risk-on, risk-off shocks. So let's say that there are two countries. One has a tighter preemptive macroprudential policy stance. So ex ante, they have tightened macroprudential policy to make the banking system more sound. And then you have a country that hasn't quite done it in that way. And you hit them with a shock, a global shock. And you see actually that the countries with the tighter preemptive macroprudential policy stance experiences more volatility in terms of bond outflows, right? It's definitely moderated the leverage in the banking system, but it sort of tends to make countries, according to our evidence, more vulnerable to portfolio outflows in the form of bond and equity outflows.
That's really interesting. So is it correct to think about it this way? So just like we were talking about the supply chain, when you really fine tune things, you lose flexibility, you lose optionality, you become very rigid. It might be that this policy, macroprudential policies work in good times, but it actually makes the system very rigid. It cannot really take the shocks in anymore. Is that the right way to think about it?
That's actually a great point that you brought up, because our data set really provides sort of fine detail about the data. So we can actually look at different types of policies, right? How did loan to value ratios do? How did measures in foreign exchange borrowing do in the context of these global risk shocks? And what we find is that the more generalized buffers, which are these counter-cyclical capital buffers, right, where you save during good times and the capital requirements and so on, you're kind of building these cyclical, counter-cyclical buffers in good times that can be used in bad times. So these more generalized what's known as CCYB, counter-cyclical, these buffers have, during the COVID crisis, could be completely relaxed, right? So they have precisely that flexibility that we were talking about, that, you can't suddenly change the loan to value ratios or, those specifically targeted policies are more inflexible. But when you have generalized buffers that are really, they are providing a buffer and a cushion during, you build it up during good times and you can use it in bad times.
Yeah, and they have to go positive and negative in some sense, right, for it to be effective.
Exactly. And we saw that, right? We saw it going positive. And as soon as the COVID crisis happened, if you look at the graphs in our papers, it's relaxed immediately.
Yeah, I mean, those types of policies, I don't know much about this, Anusha. Those types of policies, at least intuitively, feels like would be more efficient than, sort of ad hoc stepping in and, trying to do something after the shock happened. If you have sort of stabilizers built into the policy regime, it would likely to be more efficient, I would think, right?
Right. And that's the whole idea behind the counter-cyclicality of fiscal buffers, right? That they come into play during recessions and so on. So automatic stabilizers, but that kind of notion of flexibility that is conditional on the state of the economy.
Yeah, unfortunately, shocks are going to be with us. This is not the last one.
Yes. Yeah, absolutely.
So you have a very recent paper, The Unholy Trinity, Regulatory Forbearance, Government-Owned Banks, and Zombie Firms. You say the paper examines the impact of asset quality forbearance to alleviate loans under temporary crisis-induced liquidity stress on the allocative efficiency of credit. The predominance of government-owned banks and an external crisis facilitate identification. So if I understand this correctly, Anusha, the government-owned banks sort of keep firms on life support alive in a bad way. Is that the issue?
Yes. And when we wrote this paper, it refers to what happened in India during the global financial crisis. But during the COVID crisis, many governments around the world have had some form of forbearance, right, for borrowers, and they households or firms. That all of a sudden you're not able to go to work and your income has taken a hit, and you may not be able to make your mortgage payments, or firms may not be able to service their loans, and therefore forbearance is called for, right? So in theory, the rationale for forbearance is that if you have a temporary liquidity shock, right? You're not insolvent, you're just having liquidity problems, then to give some form of relief to borrowers that will help them tide them over during this time of temporary liquidity. And then they'll be, given that they are solvent, conditional on being solvent, once the liquidity crisis passes, then you can make good on your loan payments. And so in the case of India, what we see is that during the global financial crisis, and this is sort of coming full circle to trade disruptions, right? So there were a lot of Indian firms that were suppliers to, were exporters, were supplying to firms outside of India that may have been hit adversely by the global financial crisis. And so the Central Bank of India, the RBI, stepped in, and they basically said that, okay, we're going to provide forbearance to banks. And the idea being that if banks could say that a loan was under temporary liquidity stress, they would be given relief in terms of the capital provisioning, right? So if you have a loan in good standing, it has a certain kind of low capital provisioning rate. But if a loan starts missing interest or principal payments, then it's starting to become a more risky loan. And therefore, the safeguards that are in place in terms of loan loss provisioning or capital provisioning is that then the bank has to commit more and more capital against that risky loan being out there. So during the global financial crisis, what the RBI said was that if banks could say that this loan is under temporary liquidity stress, then they don't have to increase the capital provisioning. And they gave a special, class. It was called the restructured assets. But the policy itself was quite opaque. It didn't specify precisely what does a loan under temporary liquidity stress mean. What is liquidity stress? It didn't define liquidity stress. And we know that if we just look at accounting measures, it's notoriously difficult to distinguish between liquidity and solvency. So it just provided banks with this opportunity for regulatory arbitrage that you could just claim that a bunch of insolvent or firms that were not being able to pay from before, you could just sort of put them in this liquidity stressed bucket and kick the can down the road. And what that meant was that there was this huge buildup of stressed assets in the Indian banking system. And part of the problem is that if you're going to evergreen a bad loan, which is a phenomenon known as extend and pretend, then you're essentially gambling for a resurrection, right? Somehow this zombie firm is going to rise up again. And what's interesting is that given the predominance of government-owned banks in India, we are able to exploit that margin, right? So there's a differential behavior. The private banks were not engaging in this kind of zombie lending and restructuring assets on such a massive scale. Whereas the government banks, that might be subject to political economy constraints, had lent a lot to the infrastructure sector where loans were, not performing. We can actually see that there's a very highly significantly differential response on the government side, which is related to what some have called fiscal dominance, right? Because if a government bank goes belly up or is very close to going belly up, the sovereign has to step in and recapitalize it, because ultimately it's part of the sovereign's balance sheet, right? And so in a sense, for this type of forbearance becomes an implicit subsidy from the sovereign that allows the government to kick the can down the road. But then, the chickens always come home to roost. And, we've sort of seen these massive restructurings in the banking sector in India.
Yeah, in some sense, it's a transfer between good firms and bad firms. And I remember, I think, in one of your papers, you talk about previous default history is highly predictive of future defaults. So in real markets, history is actually quite useful from a predictive perspective. In financial market, it's not, it's a random walk. But in real markets, history is actually quite useful. And so if we are not using available information in making those decisions and becomes sort of a handout, then that's never going to really work, I would think.
Yes, and actually this is sort of, it's more turning a blind eye, right? We know that things are going south, but we're just going to prop things up because bank recapitalization is going to be very costly. And it's going to, especially if you don't have fiscal space, right? It's all going to go on the government's books. So if you don't have the fiscal space on the government's books to undertake this type of recapitalization, it's easier to sort of try and turn a blind eye and ignore the problem for as long as possible. And forbearance becomes a means of providing that implicit subsidy. And that's one of the things we argue for in this paper, that many countries around the world have implemented forbearance policies, and given that we find that these perverse effects of zombie firms getting credit and healthy firms being pushed out. And then we find the separating equilibrium where the unhealthy firms are matched with the government banks and the healthy firms have migrated to the private banks, right? Those sorts of allocative inefficiencies are something to kind of keep an eye on as countries kind of come back from COVID, and these regulatory forbearance policies have to be rolled back.
Yeah, it's everywhere. I think not just in emerging markets, but also developed markets, I would think. The beauty of free markets is that it requires bad firms to go away or be recycled. If we are unable to do that, then we can't really make markets work, right? So it has long-term implications, right? So I just want to finish up with your latest paper here. Does capital scarcity matter? You say standard welfare calculations indicate that to be indifferent between a benevolent social planner implementing capital account liberalization or not, the representative household would require a 44% increase in consumption to remain in autarky for 5 years after being presented with an option to opening up. So, so this is a country, let's say country X had sort of a central planning regime or socialist regime or something like that, and they're sort of opening up to the world economy. They could, or they may not. But you're saying if they don't, there is a sort of a consumption differential about 44%.
Yes. So what's interesting is that there's been this whole debate, right? It sort of centers around whether free capital movement in the international financial system is beneficial for capital poor countries, which is namely emerging markets, right? And when we talk about the central planner in these macroeconomic models, it's basically just have the policymaker. Just think about the central planner as the policymaker. And so the idea is that it's a very controversial topic because, on the one hand, when countries in financial autarky open up, as they did in the 80s and 90s, a lot of these emerging markets came online, capital flowed to these countries, the cost of capital declines, real investment goes up, we document some impacts on growth. At the same time, this capital is pretty, it's pretty, it can move freely, right? So any bad shock, it comes out. The debate in international finance has been that, the kind of volatility that these open capital markets pose for these emerging markets, that the welfare consequences, it's really not clear that these countries should be opening up. And so that's the question we ask in this paper. And what we find is that the modeling technique that a lot of papers that argue against open capital markets in the international system, they're using, in their modeling, they're using an infinite horizon, right? So what happens in these models theoretically is you open up, you get this windfall of capital, and the country catapults to the world steady state, as we call it. But all of this action happens in sort of the first 20, 30 years of the model, right, of the representative agent. Whereas if you calibrate the gains with your denominator being the infinite horizon consumption gain, you're taking the first 20, what happens in the first 20, 30 years before convergence, and you're dividing by a very, very big number. So you're basically, getting a very small number as the welfare benefit of opening up. And so we do this, it's this consumption equivalent. You ask an agent, would you rather be in autarky or in openness? And then you compensate the agent to be in autarky. And we find this very large compensation that would be needed in the early years. And our argument is that, 20, 30 years, or even 5 years, that's a policy relevant horizon. It's not the infinite horizon. And that's the kind of theoretical point that we were trying to make in this paper about why capital scarcity matters and how much it matters for the welfare of households that live in capital scarce countries. And once again, we're seeing that in Russia. Capital scarcity matters.
Yeah, this is really interesting. There's a lot of policy implications. So this is not the research, but I want to ask you, when I look at India and China, I know that you have done a lot of work on emerging markets, including India. It seems to me that there are two types of liberalization. So the initial conditions for both of these countries, maybe 60, 78 years ago, is approximately equal at $1,000 per capita GDP. China is sitting at $10,000 per capita GDP, and India is at $2,000 per capita GDP. And you wouldn't imagine China to be, this liberal, free economy by any stretch of the imagination. So what differentiates these two countries?
So I think, the fact that India is a democracy matters, right? So democracies are they're messy, whereas in China, they can have this control planned way of developing the country and kind of have a vision, a policy agenda, and implement the necessary reforms to bring China online in terms of delivering goods and services, becoming an export powerhouse, and so on. Whereas in India, the reforms have been, the initial reforms were quite big, but after the balance of payments crisis of 1991, but following that, it's been very piecemeal. And, there's a funny stories that somebody told about, privatization of state-owned enterprises, for example, where this MP, as opposed to have said, yes, I think privatization is an excellent idea. Just don't privatize the plant that's in my constituency. So, you have to deal with the political economy of these reforms in a country like India. And there are very small things that haven't changed. For example, in India is labor abundant, just like China, but there are all these kind of restrictions on, calling a firm that's over 100 workers as a large firm. That's by no stretch of the imagination a large firm in the rest of East Asia. But that means that all these formal labor laws kick in, which would make it very difficult to, sort of have the labor market flexibility. And so you have this bunching at 99 or 49 workers where these laws kick in, and you're not able to take the economies of scale into account. So, those pictures of 1,000 seamstresses in one big Chinese factory, you won't see those pictures from India. So I would argue that, the labor abundance is not being taken advantage of.
So in conclusion, Anusha, so if you were to pick 2-3 policies for India to get back on more on a Chinese footing, let's say, what would that be? What would be the 2-3 things that India needs to do?
So I believe these firm size restrictions are really choking off manufacturing. I think it's this atypical transformation of India, which is labor abundant, but the manufacturing is stagnating, and the services sector, which doesn't employ as many people, is thriving and driving the growth, is rather perverse. And if so, measures to get the manufacturing sector going, such as easing up on firm size restrictions, or these notions of special export zones where you don't have to fight about getting electricity and water and all the things that are necessary, harnessing the ports and kind of making those sorts of a few examples of special export zones possible. Those are the kinds of reforms that I think are necessary, because agriculture is not as productive, and you have so many huge fractions of the labor force underemployed in agriculture, and they're not being able to be pulled into manufacturing. And then the third thing I would talk about is educational reform, where everybody feels compelled to get this generic BA pass degree, which is not really equipping anyone to do anything when they are done, but kind of perhaps adopting more of the German model, where there's an emphasis on vocational training and skills development, where people don't have to get a bachelor's degree. They can just get a vocational training certificate that then can be deployed in a variety of manufacturing industries. So those would be my 2 or 3 reforms in my wish list for India.
Yeah, I particularly like the third one, Anusha. I remember when I was growing up in South India, bus conductors had, masters. And so there is a sort of a policy question, which is there's no point getting educated if there are no jobs for that education, so to speak, right? So I think we are missing sort of the planning, education planning appears to be missing in India.
Right. Yeah. It's just sort of creative thinking, providing people with options, having tracks, right? Countries like Germany have done it. And there's no reason. We know from the services revolution that with a little bit of training, India could really transform into a services powerhouse. And I think the same needs to happen on manufacturing, simply because of the numbers of people in the workforce.
Yeah, I want to touch on one thing. We talk a lot about artificial intelligence, robotics here now. There's a general sense that humans might be replaced by machines in routine jobs in the future. What are the implications of that for a large country like India with 1.4 billion people?
Yeah, it's sort of it's really interesting to see what will happen. What's interesting to me is that given the issues with manufacturing laws in India, you'll be surprised to hear that this labor-abundant country in auto manufacturing is using robots instead of people, because you don't have to worry about laying off a robot, and so it's already happening, right? Where your example of the bus conductor with the master's degree, you have huge swaths of unemployed youth, and India has 150 million youth in this kind of college going age, and they're all going to be coming online, because India does have a very young, in terms of demographics, it's skewed towards being young, which can actually be a huge advantage, right? It can be something, an asset that can be levered, where other economies, including China, our populations are aging. And it's just going to be a matter of how is that harnessed. And, I think, robotics and artificial intelligence, I'm sure it can play a role in helping that to happen too.
Excellent. Yeah, this has been great, Anusha. Thanks so much for spending time with me.
Thank you for inviting me. This was a pleasure.
Thank you.